How y'all doing? Matt Repass, Ocean City Retirement Educator here. Today I want to talk about the tale of two decades and a concern that I have because while we see so many articles in the business sections and the newspapers and on TV about how this stock market of ours is booming and interest rates are staying low, I have a greater concern because there's just so many things that are saying there's warning signals to me flashing left and right. Why? I've spent 35 years of my life in this business. I love what I do. I don't work a day in my life. However, the flashing warning signals that are going off are almost as much as they were in past market calamities like 2000 and 2008. So if you are a working person and you're contributing to a retirement plan, down markets, no big deal for you. Many of you who work with me were still working when the last down market, the 2008 market crash, occurred. You remember it took you quite a while to get back to even. So I want to examine for you the tale of two decades here, and let's look back over the last 20 years through these 2-3 charts that I have, and let me see how you feel about what we're going to. Because if you're almost retired or getting ready to retire or just into retirement, you need to find out and do a little gut check on how you feel about where this market's headed. Is it going to keep going up like a rocket ship, or are we going to go back to a prior decade? So in the chart you see, we're looking from year 2000 to 2020. An investment in just the old S&P 500, the 500 largest companies in the United States, just a typical stock market investment that people would make. They've made in their 401ks for years. And you'll see that red line representing the S&P 500 staggered out of the gate, but has gone up 6.16% over the last 20 years on average, and accumulated $383,000. Now, we haven't added the COVID crisis in there, which took quite a bit of it out in March of last year and has since recovered. So we're just going to measure the first 20 years. The green line, on the other hand, is a tool, an investment tool, a savings tool that we use called indexing, where it is a have your cake and eat it too scenario. Over that same 20 years, you'll see that indexing, where the amount of money you have left is a little bit less. The average return is 5.85%. But you'll notice why I say it's a have your cake and eat it too is, let's look at 2019, a year where the S&P 500 shot up 30%, 31.46% to be exact. Our indexing component only went up 10%. We're capped in that instance in this example. Well, why do I say it's have your cake and eat it too? You think I lost 21% there. I want to take you back to the first decade of this century, 2000 to 2010. And you'll see that the first 3 years in the dot-com market crash, we didn't earn a dime in our indexing, but more importantly, we didn't lose a dime either. The market recovered back during up to 2007 when the Great Recession again knocked that money out. Why indexing was so far ahead is I can gain up to 10% in this illustration, but I could not lose a dime even when the markets fall. So a have your cake and eat it too scenario. Why is that important? It's more important not looking backwards, but looking forward for you retirees. Because let's look here at the scenario that if our next decade, because we haven't seen a market crash now since March 8th of 2009, and in my 35-year career, we've had a market calamity, call it what you want, about every 5 to 7 years. That's historically how often they happen. Well, we haven't had one since March 8th of 2009. The market has basically gone up like that. But let's go back to the first decade, 2000 to 2010, which actually was extended to 2012, when that same S&P 500 which in the prior slide made us so much money, had 12 and a half years of zero growth because of the dot-com crash, because of the Great Recession of 2008. Our markets took away 47% and 53% respectively, and it took 7 years, 1 month to recover from the dot-com explosion and 5 years and 5 months to recover from the Great Recession. Combined for 12 and a half years where we have zero growth. Now, a working person, if you were still working at this time, you basically were buying on sale in your 401k or 403b. A retiree, however, somebody just getting close to retirement or walking into retirement, or those already retired, this is an enormous problem that we need to address and that I deal with every day. If we look at the very first decade, the first 10 years, and take half of that equation of the first slide, let's examine what the S&P 500 investment, that stock investment, did. You invested $100,000 and 10 years later, if you didn't take any money out, which is not what retirees are going to do, they're going to take money out, you actually end up with less money. And this is not moving a dime from it. That same indexing illustration that I gave you, the half of that, it earned 4.46%. So if you like the idea of protecting your money, getting some good returns in good years, but having hands off and no loss during the lost years, adding indexing to your portfolio might be a good idea. Because if you're like me, I'm fearful that this is the decade we're headed to, not another decade like we've seen in the past 10 years. Click below if you'd like to spend some time with me on the phone. It's at no obligation. I look forward to speaking with you.